if you look at what extreme looks like, the bullish setup pop up in the screener is only 7, although a lot more of them is still hidden from a screener, but still there's way too little. And compared to the bearish setup, more than 800, the ratio that we haven't seen before is almost like 1 to 100. For every one bullish setup, there are about 100 bearish setup. There's very, very negative market environment. And in terms of the market breadth, it's also pointing to deeply oversold and also extreme oversold. Where exactly is the deeply oversold? As long as it's below 20, I consider it as a deeply oversold for the long-term market breadth. And compared to last week, this has changed significantly from about 35% of the stocks above the 200-day MA down to only 17% of the stocks above the 200-day MA. That's only very, very little stocks are above the long-term MA. And if we pay attention to the short-term breadth, only around less than 5% of the stocks above the 20-day MA. That is quite extreme. I consider this as an extreme oversold condition. This is quite meaningful, and that's the slide for the weekly 200 MA. But before we dive into this chart, I would like to take a look at the market breadth from the chart perspective. We want to compare what's happening when I classify this as oversold or deeply oversold. This is MMTW. That's the percent of the stocks above the 20-day moving average. I draw a few lines. There are green box, green line, and also the blue line that is below 10 or 10. Anything below the blue line is less than 10% of the stocks above the 20-day moving average. And for the red line, that is quite extreme. From about 2015, 16, 2018 is here, and 2020 is here. And also the bear market 2022 is somewhere around here. We had this dip into the red line, below the red line. In the past events, we only had the COVID crash here, and this 2018, that's the Christmas period, 2018, December, very close to 2019, the US-China trade war. And that's the beginning of the trade war. And also 2015, 16, we also have this extreme oversold condition. It only happens a few times in the past 10 years. Later, we'll dive into some of the market breadth analog, but that's from the long-term breadth perspective, because that's even a rare event if we look at the percentage of the stocks above the 200-day moving average. I could quickly show you this chart here. Currently, it's right at below 20. Anything below 20, I consider this as deeply oversold, because this is the long-term MA. The percentage of stocks above the 200-day MA, it takes quite a long time for it to react unless in a bear market or a market crashing condition. Back in 2015, 16, we have the two instances, dip to below 20, and that's dip to somewhere below 15. And during the Christmas 2018, we have one crash right here and a V-shaped rebound, and that's during the COVID. That's even below 5. That's quite extreme. And during the bear market 2022, there are two instances right here that's deeply oversold. And we'll look into that one by one shortly. And let me get back to the slides. And let's take a look at this chart here. Purple line MA is the 200-day MA, but this is a weekly chart. That is a weekly 200 moving average. And in the past 10 years or even 15 years since the global financial crisis, somewhere around here, since we have this basis built up, it tested a few times. after the crash in a global financial crisis, we have this going up, come back, have a test of the 200-day MA from the weekly perspective, get supported, and 2015-16 is almost tested, short of 100, 200 points, very close, that's close enough. And during the 2018 December, touching, and in the COVID, that's undercut and then bounce back up. And in 2022, bear markets, that's very close and that's supported and eventually started another bull run rally, close. Back in 2023, another 300 points, 200 points, somewhere around here, that's close enough, but the chart is still developing, still unfolding. We couldn't be sure that whether it's not going to touch it or it's going to take some time. It could act like 2022. Here is close enough. And we have a technical rally. That is an automatic rally after the deeply oversold condition. And then have another test, a lower low test, which I tested the 200-day MA. But anyway, all this year shows that this MA act as a support line very well, apart from the COVID crash, which is kind of expected because COVID is like the end of the world and a lot of people dying from COVID-19 and is full of uncertainty during the COVID period. We are close to the 200-day moving average. I would say this is somewhere around 4,700. Pay attention to that, and that should act as a support according to this chart. So that's one perspective, because if you have been following this webinar and following the price and volume, you know that we don't look at pure support, resistance, or the MA. They all act well and play a bit in the chart, whether it's a structure, whether it's a moving average, or whether it's a trend line, whether it's a horizontal resistance, support. They all consider as the technical indicators, but ultimately we need to see how the price interacts at the respective resistance or support level, and whether we'll have the increasing of the supply level or decreasing of the supply level, and everything need to read in context, with the right context. The first one of the market breadth analog is 2022. That's the MMTH versus the S&P 500. MMTH is the percent of the stocks above the 200-day moving average. That is the long-term market breadth. And I align these two charts. The purple color line is the S&P 500. The blue line is the MMTH, the percent of the stocks above the 200-day MA. Whenever we have the DB oversold condition for the percentage of the stocks above the 200-day MA, means when it dip below 20, like less than 20% of the stocks above the 200-day MA, we should see technical rebound. In this case, it occurs somewhere around June, but right after that, we also have a higher low form somewhere in July, and the automatic rally started somewhere in July. That is an impressive rally. Prior to that, for example, this kind of the rally is not considered as automatic rally. One thing to take note is even we get a DB oversold, it could stay in the oversold level for some time. It could be a few weeks, and it could even be 1 month, 2 months, or even 3 months. We'll see that shortly, especially in the 2008, the global financial crisis, and also the 2011, the believe is the European crisis. Something to take note. And even if we get this kind of the automatic rally, for example, if you believe that this is the low, after this market breadth dip below 20 and bounce back up, sure, we get an automatic rally, but right after that, here is also another test. The S&P 500 also has another downswing, undercut the previous swing low. And yeah, There's a first instance, there's a second instance, and only after that, we see a higher low form right here. And the market breadth kickstarts the rally. That's something very important. First, we have this kind of the bottoming structure and the bottoming rally. After it undercut this, the market breadth give us a hint because the market breadth have to trust all the way to around 65% of the stocks above the 200-day MA. Means that a lot of the stocks are participating, even though the S&P 500 doesn't seem like going anywhere in this sideways movement. The only bullishness that it has right here is a higher low. That's it. Here is still a lower high, but this is also showing otherwise. There's a bullish divergence. That's a 2022 analog. Another one during the COVID crash, that's almost like a V-shaped bottom. After the blue line dip below 10 or even somewhere around 5, dip below this red zone, we also notice here is automatic rally. This bit right here, automatic rally. But from March to about April, or March to 1st of April, this market breadth doesn't have a strong rebound. S&P 500 has a strong rebound first, and the MMTH catch up slowly. Anyway, the real structure form after somewhere around here means after the market breadth get above 20. Anything below 20 is considered oversold. There's a DB oversold, there is an extreme oversold. If we have that market breadth below 20, where is 20, where is 10, where is 5, they all consider as oversold. Nothing good happen when you have this kind of the oversold condition because it could stay in that zone for quite some time. In this case, from March until May, the whole chunk right here, around probably 2 months period, we have only less than 20% of the stocks above the 200-day. I mean, it means that a lot of the stocks do not participate the rally. It means majority of the stocks are still relatively bearish. And after that, after it above the 20%, we also see the index started to rebound much better. There's a much better and much more obvious market environment and also market structure. Next one, 2018, it started somewhere around 2018 January. That's first where we have the buying climax form and followed by the US-China trade war with a change of character and subsequently have an uptrust and increasing of the volatility, redistribution, and eventually crash. When the market crash, same as the market breadth, the blue line dip below first the DB oversold zone below 20, and subsequently is also below, well, it's touching 10, right? Touching 10, but after that we have a quite a quick recovery, almost like a V bottom, charge it up. The real very obvious buy point that could be somewhere around here after it come out from 20, so somewhere around here, get back above the trading range. But anyway, that's from the index perspective, S&P 500. In real life trading, we do not, unless you want to buy the S&P 500, the ETF, the SPY. Most of the time, we handpick the stocks, the outperforming stocks, and we trade the stocks rather than the index itself. After the market sort of come back to stability, we will notice that a lot of the stocks, especially the outperforming stock, those stocks that shows the relative strength, they will be the first to break out. They will be the first to charge up. Those are the stocks that we want to be in, they want to buy. And The next one, 2015, 2016. This is even more volatile. To the downside, we have this crash. To the upside, we also have quite a big shakeup going to the upside, crash down, going up. And after that, we also have another crash down, going up. Very volatile, and same as the market breadth. When the market breadth first touched the 20, dipped over so, have that kind of the automatic rally. That rally represent a huge rally in the S&P 500. And same as this instance, after it touched a 20 and it has another strong rally up, same as this strong rally in the S&P 500. And unfortunately, even if we have this kind of a strong rally going back up to near the previous high, here is another localized distribution and have another crash down with this market breadth deep below 20, go to the DB oversold level, close to 15. But where we have this kind of the market breadth deep below the critical level, considered as the oversold or deeply oversold or extreme oversold, we could somewhat expect a technical rally. This is a technical rally, but even after this technical rally, the next downswing undercut the previous swing low, something that we need to take note. It doesn't mean that after the rally, then the bottom is set, the bottom is in. It doesn't. The bottom is still have a lower low. That's the bottom. And even here is also a temporary bottom. Here is also another temporary bottom. Even after this sharp rally, we also have the localized distribution. Do not bet on the bottom is in, even after we have the oversold condition, deeply oversold condition, or even the extreme oversold condition, because we have many instances where we have a lower low form. Although you could argue that if you are a super long-term investor, if you buy somewhere around here, and when you only buy the SPY, the ETF, because we are looking at the S&P 500, buy somewhere around here, you probably only have some minor drawdown. Here is a drawdown. Here is also some drawdown, but you get stuck within this bearish period for 6 months, almost like half a year. Not to mention about if you are looking to handpick some of the growth stocks like NVDA, AAPL, some of the very obvious growth stocks previously has a super growth. Even after a correction, a new batch of the leaders will be born from there. They are not necessary to be the growth stocks forever. And next one, 2011. For 2011, that could be a European crisis, or at least that's what the newspaper, the headlines show us. Right after the global financial crisis, 2011, we have some problem back in the Europe. Here is the S&P 500, a topping formation, and subsequently here is a breakdown and crash. Look at the market breadth as shown in the blue indicator. From about 50% of the stocks above the 200-day moving average, quickly crashed down to below 20. Around 17% of the stocks above the 200-day MA means that a lot of the stocks get burned down and a lot of the stocks crash down. And notice how long it could stay deeply oversold or oversold. I sort of highlighted here from August, September, at least to October. Look at this, around 17, and that's at best about 25. This period, the 3 months period, we have less than 25% of the stocks above the 200-day MA, and it could stay oversold for quite some time. And even the index have an automatic rally. Well, when it first touched the deeply oversold zone, we have an automatic rally. That is the relief rally. That is the automatic rally when the headline would like to broadcast, because after this huge sell-off, deep oversold, and we have the ornamental rally. But look at the rally. It doesn't go anywhere, forming in trading range. And look at how weak is a rally. This sort of the rally is probably around 30%. If you put a Fibo, then that's roughly around there, about 30% of the rally. That coincide with the market breadth. The market breadth stays in this oversold zone for quite some time, at least 3 months. After the 3 months period, after the spring, a sign of strength coiling, that is probably some form of the good size, and a lot of the stocks might be recovered. But even then, there's only around 30% to about 40% of the stocks above the 200-day MA. But that's from here on, there will be a lot of the stocks showing good relative strength. The outperformers will start to break out. Those are the stocks that we want to catch. But here is also another shakeout. Look at this. This is quite a deep shakeout. And even with this kind of the deep shakeout, the market breadth also dipped below the daily oversold zone. 17%, somewhere around 17% of the stocks only above the 200-day MA. That is still quite a bad market environment. Can you imagine less than 20% of the stocks above the 200-day MA participate on the rally? Again, this sort of the period, the headline will be very bearish because a lot of the stocks are still in the bear markets and they are still probably building up the base. It could look something like this, automatic rally, and they could still consolidate or even form a lower low, something like this. That is still quite depressed, and the headline will be bearish, especially if you have a lot of the economies. They have a lot of the data to back up. Probably the European crisis is real, but who cares as long as the market is building up a base, coming back up, and the market always run ahead of the economy, roughly probably 6 months to 9 months or even a year of the time frame. What we want to catch is the trend. Pay attention to this. Another one, or the last one, is the global financial crisis, 2008, 2009. That's even worse. That is the worst that I have seen in terms of the market breadth. Look at how depressed is the market breadth. We have this crash here, and same as I should start from here. If we take a look at the green box, that is the oversold zone. Whenever we have the market breadth touch this deep oversold zone, we could anticipate a technical rally. Here is a technical rally. Look at how zigzag it is the S&P 500. It doesn't take like a few days or even 1 or 2 weeks. Here is almost like 2 months of the movement for it to have a good rally up. But after that, come back down, touch a deeply oversold zone, have a anticipate another relief rally or technical rally. But look at the rally this round. This round is super weak. The rally is too weak compared to the past. That is very, very weak rally. And this weak rally lead to a quick sell-off or a crash. Here's a crash of the market, and we have the market breadth dip below 10. That is what I call the extreme oversold. But having this kind of extreme oversold doesn't mean that you need to rebound quickly off the extreme oversold level. Look at this. It stays in this extreme oversold zone for since October, November, December, January or February, or even until March. It's still kind of deep back here. This half a year period is very depressed. Less than 17% of the stocks are above the 200-day MA. Means that a lot of the stocks are still in the bear zone, bear market. They are still probably forming the base, forming an accumulation, or it could be a lower low, like a down sloping type structure, same as the index. Look at the index. That is a down sloping type of a structure until we have a sign of strength rally and a backing up process. The real movement starts 2009 July after the breakout. That is the structural selling climax, an automatic rally, and we have a down sloping time of the accumulation range until we have the sino strength rally, a backing up process. Then we have a much better market structure. Anyway, after going through all these analogs from 2022, 2020 COVID, 2018 December, and the US-China trade war, 2015-16, that is another choppy period, and also 2011 European crisis and the 2008-2009 global financial crisis, they all have one common theme. What's the common theme? The common theme is, let me bring up the trading view. The common theme is when we look at the percentage of the stocks above the 200-day average. Let me switch to line chart. Whenever we have the percentage of the stocks above the 200-day MA deep below the oversold zone, classified as the green line, somewhere around 20, as long as it's below 20, I consider it as a deep oversold, and even go into the extreme oversold, like below 10, we could sort of anticipate technical rally, a technical rebound. But even we have that kind of the technical rebound, most of the time, we're going to see another test. And most of it are a lower low test. For example, 2008, 2009, after the technical rally, here is a lower low. After a technical rally, here is also another lower low. Watch out for that kind of the rally or automatic rally or relief rally. Even the 2011, we have the technical rally, and after that, we also have another dip. Do not purely rely on this sort of the indicator. Even if you check out the market breadth indicator together with the long-term MA, the weekly 200-day MA that we discussed earlier on, that's still not enough. The real confirmation is still the price. We need to check out the price and also analyze the price of volatility together with the supply level, and before we can confirm the bottom. And the only good thing is we do need to know when the S&P 500 is going to be bottom, because what we're going to do is to trade the outperforming stocks rather than the S&P 500. Of course, the S&P 500 is a good proxy that we could take advantage. For example, we could buy the SPY ETF whenever you have that kind of oversold condition. In the long run, for example, if you plan to hold it forever, as long as there's no the third World War III, no World War III coming, then most likely it's going to go up after the volatility periods. Another one, 2011, next one, 2015, we also have a lower low form. After the oversold condition, here is a technical rally, here is a technical rally, but even we get that kind of technical rally, there is still a lower low form after a few months. It's something that we need to bear in mind. Same as the 2020 might be different because that's a V bottom. We have a strong rally up, and also 2020, 2022, here is also another one. There is a technical rally. That is a lower low form. After the technical rally, we still could get a lower low form from June to in another 4 months, 5 months. I do want to bet on an extreme oversold condition based on the market breadth and call this a bottom, because bottoming is a process, not an event. And look at how long the bottoming process took. Even after the change of character automatic rally, this whole chunk right here is the bottoming process. Until we have that kind of the breakout, the rest are still quite choppy. But the good thing is, during this consolidation periods, we also have some outperformers showing up. That's something that we need to pay attention to. The weekly chart 200 MA is something that we also want to take note of.